To any members who may ask. It is open to the public, so other members of the public may join the meeting as well. And we can go ahead and kick it off with item 4A, or Jeff, if you want to do some introductions before we go ahead and start the agenda. Or Carrie, somebody from finance. Jeff Keel.
I think he's struggling to get in, but
Let's see. Okay, he's calling in. This to be a phone line. Okay, I think that was him I just let in. Jeff, are you on the line now? No. You might be muted, Jeff.
I think we can.
Do you want to just start?
Yeah, I'm going to go run overhead and
okay.
Have
Can
Jeff.
you hear me now?
There he is.
Okay.
We can.
Yeah, that's why I wanted to test this before. I'm having trouble getting my video too. So yes, we have Jason Schmidt and Mia Corral Brown from Chandler Asset Management. They're going to give you the report through the second quarter. I'll turn it over to Mia and Jason.
Hey, Jeff, just real quick, this is Sylvia. It looks like your camera is on. You may just have it, it looks like it's facing via a wall or something. I'm not sure, but
No, I only have it. It's built into my laptop.
Okay. Okay.
All right, so I want to make sure that everybody can see my screen. Great. And so what we're going to do is we're going to talk a little bit about what's been going on in the economy, then talk about the investment portfolio, and then take any questions that you may have on this. We were thinking about taking at most about 15 minutes to review the investment portfolio. So the virus continues to capture all of our thoughts and also the economic activity that's going on in the United States and globally. We are starting to see vaccinations and especially starting to see some larger vaccination centers that are opening up in large metropolitan areas. So the vaccinations have definitely been underwhelming as far as what the expectation was for those, but we are starting to see that pick up, and that we think that eventually we'll start to see things as far as the numbers start to get better, and some of the lockdowns, as we've seen here in California, start to be relaxed a little bit. The Federal Open Market Committee continues to keep rates low and also a very accommodative monetary policy. So they're keeping short-term interest rates between 0 and 0.25. They're also purchasing Treasury and agency mortgage-backed securities. Treasury securities at about $80 billion per month. Mortgage-backed securities at about $40 billion per month. So definitely we're seeing where the Federal Reserve continues to have a very accommodative tone, and that tone is likely to continue, especially from the questioning that went on at the last press conference in the last couple of days, where Chair Powell said that they're not thinking about really changing their monetary policy to a more restrictive stance, or what they would call tapering, meaning they would taper the purchases. Then you have 2-year U.S. Treasury notes around 12 basis points. We are starting to see a little bit of a steeper yield curve. I'll show you that a little bit in the future, and especially in the month of January, we saw the yield curve steepen, i.e. longer term rates went up faster than shorter term rates over that period of time. Moving on to page 4, you can see the employment situation. So you can see on the left-hand side, that's non-farm payrolls. The green line there is the headline number. The dashed line there is the 3-month moving average. You can see that things have moderated somewhat, especially since the downturn that we saw almost a year has gone by since we really saw that large downturn, and things have definitely moderated since that period of time, if not gotten weaker since we saw the spread of the virus increase and also some of the restrictions go on in local municipalities. And you can see the right-hand side, you can see that's the unemployment rate. The dashed line there is the underemployment rate. Those are those folks that might be unemployed for economic reasons, such as they want to work full-time, but they're maybe working part-time. And then the green line there is the headline number, and we really saw it come down. But of course, what we haven't seen it do is really come down below those pre-pandemic levels. And so with that in mind, the Federal Reserve is still keeping that very aggressive of monetary policy that they have today. I'm not going to spend too much time here on page 5. This is just what we call here initial jobless claims. The green bars down there are the initial unemployment insurance, and the gray bar there is the continuing claims. All you really need to take away from here is really that things have come down from those higher levels, but there still is a persistent amount of unemployment in the economy from a relative basis to where we were pre-pandemic levels. Moving on to page 6, you can see inflation. So on your left-hand side here, the green line there is the year-over-year change. The dashed line there is what we call the core CPI. And so the core CPI is looking at ex food and energy. You can see that inflation numbers have come up, but still below the averages that we saw previous to the pandemic. And then what you can see here on personal consumption expenditures. So you can see the green line there was year-over-year numbers. The dashed line there was the core number. And you can see that that also is below that 2% that the Fed has targeted. And so you can see that inflation is definitely not the enemy here. It's really economic growth that we need to continue to expand. So this will definitely, as long as inflation continues at these levels, we'll likely see the Fed be very accommodative on this. Then you can see here on page 7, here you can see gross domestic product. And what you can see here is just basically GDP. You can see from December 2019, the last 4 quarters. And really what you can see here is you can see the first quarter and then also the second quarter where we started to see some of those negative numbers. Then as we entered into the lockdowns and things like that in the second quarter of 2020, we really saw that pretty big plunge that we saw in economic activity. And then we saw the recovery in September, and that recovery has continued. And so we have seen also the fourth quarter numbers too. And so what you can see, I really want you to look at is on the right-hand side. So you can see the green line there, the quarter-over-quarter changes. The maroon line there is the year-over-year changes. And what you can see there is definitely we're going to be negative. We're down around 3.8% for 2020. But we definitely think that the economy is going to continue to recover. And into 2021, we'll probably see between 3 and 4% increase in growth over that period of time. And then moving on to page 8, on the left-hand side, you can see longer-term bond yields. You can see the dotted line there is the 2-year, the dashed line there is the 5-year, and the 10-year is the green line there. And then, as I said before, you can see that the steepening yield curve, i.e. that shorter-term rates have remained relatively the same, but that 10-year Treasury note has moved up a little bit from where it was before. Some of that might be inflation expectations in the market as the United States continues to have large deficits, in the trillions of dollars in 2021 with the expectation of them issuing all that debt. And then on the right-hand side, you can see there's the yield curve. So the green line there is from a year ago. The dashed line there is from September, and the dotted line there is the most recent. And there you can also see that very pronounced steepening of the yield curve that also happened at the same time. And so we're seeing some upward pressure on longer term rates, but really short term rates, I'd say 5 years and in, are staying relatively low here at this point in time. And then page 9, this is the periodic table of returns. I'm not going to spend too much time on this. This is something I do to just give some interest to the presentation, so you can see how other markets are participating here. And all you really need to take away from here is this is looking at annual returns of different asset classes going back 10 years. And so if you look at 2020, even though it was a pandemic year, you can see that U.S. stocks, mid cap, small cap, and large cap stocks, up almost 20% in all of those different categories. And the majority of asset classes were higher, even though we were in a pre-pandemic year. Some of that's because of the Federal Reserve and its relatively low interest rates. And in addition to that, people looking forward, investors looking forward, that things will be getting better and profitability will come back to those businesses and things like that. Moving forward onto page 11, looking at your portfolio. So looking at the objectives. So it's safety, liquidity, and then finally return after the first two have been met. And it's really to achieve a return that's above the benchmark over a long period of time. And we purchase securities that are consistent with your investment policy and California government code. Page 12 and 13 are looking at the compliance. And so you can see here your portfolio fully complies with the investment policy and California government code. Page 14 is looking at the different characteristics in the portfolio, and I'm going to focus in here as of 12/31. So you can see the average maturity of the portfolio is 1.98. You can see that the average duration was 1.73. The benchmark was 1.82, so a little bit below the benchmark, but very close to that. You can see the average purchase yield is 1.62%. Just to give you kind of a benchmark or a goalpost to look at is LAIF. So LAIF right now is down to around 44 basis points. So by purchasing these longer term securities, you're getting close to 4 times the yield on LAIF. And so by having that longer term strategy, it's definitely benefiting the district, not only now, but over that long-term period. It's a AA plus rated portfolio, and the portfolio is 362 million. There were some withdrawals over the period, so that's why you see the market value has come down from about 379 million over that period of time. Here you can see the different sector distributions. I'm going to focus in on December 31st here. So you can see that treasuries make up about 22%, supernationals make up around 3%. You can see negotiable CDs 7.1%. You can see money market funds 2.1%, corporates 13.1%, CMOs are 6.4%, and agencies are 35.7%, and asset-backed securities are 10.7% of the portfolio. So using all the different tools in our toolbox in order to achieve the goals of the investment portfolio for the district. Here you can see the different issuers that are represented in the portfolio. And so if you look at the very top here, U.S. Treasuries make up the largest percentage at around 22%. And then you can see its agencies make up a big percentage of the portfolio. And then as you go down from there, you can see all the different corporations that are owned within the portfolio, both that of corporate bonds and also negotiable CDs and asset-backed securities. And so we are very comfortable with the holdings that we have in the portfolio. We think these companies are very strong. Remember, we are still in a recession. Although we may be seeing where we might be starting to come out of that recession. That recession started back in March or February of 2020, and these companies still have maintained their overall credit quality and their financial stability. And you can see that also on page 17. Then on page 18, looking at investment performance. And so you can see the since inception of the portfolio was 9/30 of 2019. If you look at the bar graph, the green line there is that of the district. You can see the gray line there is that of the benchmark. And you can see that over the last 3 months on the table below there, the district's portfolio earned 18 basis points versus that of the benchmark, which was 13. And also if you look at LAIF, LAIF was up about 14 basis points over that period of time. Over the last 12 months, though, you can see really the outperformance versus LAIF. So you can see that the portfolio outperformed the benchmark 3.36% versus 3.24% over the last 12 months. And then you can see that LAIF was 1.17%. And then you can see those since inception numbers. You can also see that 3.15 for the portfolio, 3.04 for the benchmark, and 1.35 for LAIF. So really having that longer term strategy, these numbers really show that. Where the portfolio is around 2% higher than that of LAIF, of a very short-term investment vehicle. Here you can see the different purchases that were made. So we have some purchases, some sales, we have some calls and some maturities. Basically the activity surrounded around basically rebalancing the portfolio back to the strategy targets, while also being able to ensure that there was liquid investments there for the withdrawals that took place over the quarter. And that concludes my presentation, and I can answer any questions that you may have.
Hey, Jason, this is Robert Chain. I'll give the board members an opportunity to ask questions, but I did have a few in case they didn't. I think Director Aguilar's You're on mute.
Am I okay now?
Yes.
Hear you.
Okay, thanks. So just one question. I think, Jason, first of all, thank you for your presentation. I think you addressed this, but I just wanted to confirm, maybe somebody can confirm this. So that portfolio loss that you mentioned and that withdrawal that was 16 million or something, was that for capital projects or was that for operating reserves? Can somebody just clarify what that was used for?
So I believe that that was for capital projects, and it was just that the balance of the portfolio went down from around 378, almost 379 million to 362 million dollars. So that's really money taken out, being withdrawn for either capital improvement projects or operations too at the same time. So being used for the district's goals and purposes.
Thank
Jeff
you.
or Carrie, can you confirm that, please?
Yes, so this is in line with the board's direction to take down the reserves. And so that's one of the areas that we've been trying to drive down, is take down use the reserves to do for PAYGO for capital projects.
Okay, thanks.
I wanted to let's get some clarity on, I think you made a comment, Jason, on that we were in a recession and you anticipate being out of the recession when?
I would say that we were likely going to start to be out of the recession. Doesn't mean that we'll come back to below those pre-pandemic levels, but we've now been in this recession for almost 10 months now. We are seeing where you have much lower rates than the highs that we saw of unemployment. It wouldn't surprise me to see that we wouldn't be out of this recession probably in 2021. And so I think that what you've really seen is a pretty large increase in the labor market. We'll continue to see improvements there as we continue to see the vaccinations and hopefully herd immunity that would happen. What a lot of experts are saying could be, 6 months to 12 months or something like that. We'll continue to see the economy recover. And with that, we'll likely see us come out of this recession too at the same time. Remember that the individuals, the Bureau of Economic Analysis, which is the agency that's really times or tells us when we've gone into a recession and come out of recession, the likelihood is we'll already be out of a recession before they tell us that we're out of a recession. There's a pretty big lag there typically. And so it wouldn't surprise me that within 6 months or so that they might announce that we are now out of the recession.
And that spike where we started coming back up, although we're not at the same level as the pre-pandemic, when did that start happening? Did that start happening?
We started. Yeah, so as far as when we look at the labor markets in general, that's where you see kind of the largest spike that's happening, and also for GDP. So GDP, we really had that big spike towards the summertime. So that's really looking at the third quarter. So that was part of the summer and fall area is where we saw the big spike. And also that coincides when we started to see local officials loosen up some of their lockdown measures and some of their social distancing measures. And we started to see unemployment come down dramatically over that period of time. We probably will not see kind of the V shape that you saw of some of those numbers moving forward. It's going to be a much tougher way to go as far as bringing those numbers down, just because we have been, we've already seen a pretty big recovery here. And in addition to that, it may take more time to get to where we're below pre-pandemic levels. Remember that before going into the recession, unemployment was around 3.5%, which was around 40 to 50-year lows. And so it will be a challenge for us to get back to that level in a very short period of time.
Okay, thank you.
So I'm waiting for others to, if nobody else has a question, I've got two general questions, if I may.
I don't see anybody else. Robert, go ahead.
Okay, thanks, Sylvia. I guess I'm looking to you to moderate. So I guess one of the questions I think has been asked, but I'll ask it a little differently. So I think the last economic downturn we had was like in 08 to like 2010 or so. And Jason, I know you don't have your crystal ball, but you said we've been in this for, almost 12 months. Do you see the economic drivers for this downturn? I mean, this is obviously a different sort of recession, right? I mean, the economic forces are a little bit different than what created the downturn, from the last time that we experienced something like this.
Yeah, so here's how I would categorize kind of the differences between, let's just call it the 08-09 downturn to this
Okay.
downturn. So
Okay.
the 08-09 downturn was caused by excesses. So you had basically a housing excess that went on over that time, and also a credit excess that went on over that time. And the way that from a fiscal standpoint that we chose as a nation to look at that was actually to infuse capital into different banks and things like that in order to cover or to buy those bad assets. So when you think about that, that doesn't necessarily, that in and of itself is not necessarily a big economic driver at the end of the day. This downturn is very different. So there were not necessarily excesses that were being built up in the economy in the same way. The second thing is that you have a different response from the government this time. And so when you look at the fiscal response, which now is about $3.6 trillion and counting, is that has really gone into the hands of businesses that have had to close, and also consumers in the form of stimulus packages. Also you have unemployment benefits that are higher than they otherwise would be, and also it's getting into consumers towards kind of that level where their consumption rate is higher than those higher income earners. And so with that in mind, and the amount of fiscal stimulus that's in the system, not monetary stimulus, but actual fiscal stimulus, I think that you could start to see where you're going to start to see in the second half of this year a pretty big recovery that continues to go on. The other thing that we've seen is that savings rates have really exploded. So savings rates are above 10% today. And typically the American consumer does not save very much. It actually spends a lot more. So as those get driven down to that 7 or 8% level, you're going to see that's where most of the time when you're here in the papers, there's pent up demand in the economy. Most people are looking at that savings rate and saying that savings rate's likely to come down, and that's likely to come down from purchasing from consumers. So I think between the two, yes, they were both downturns, but they're very different in that there weren't the excesses that you saw in 08-09, and hopefully we'll get a different outcome where the 08-09 recession, as it dragged on, was at very low growth rates. Maybe we'll see this recession be a little bit different. But don't get me wrong, we're borrowing, $3 to $4 trillion. And at the end of the day, there are going to be unintended consequences of that. And so we'll have to definitely pay the piper, for lack of a better term, at some point in time. But it is something that, just with the facts that are out there today, I would say there's definitely a tailwind because of that.
Yeah, thank you for the economic lesson there. The other question I had was on page 15, where you kind of show like the little, well, it's not really a pie chart, but the distribution of these two different quarters. And I was just curious. Okay, so you got these different distributions here. How many of these are actually due to the fact that you're actually making changes in the contributions to each one of these? Because I know, like, with the differences in time, obviously your value in each one of these is going to change. So are there any big ones that you can kind of point out that the company managed and changed allocations in, please?
Sure. So let's take one that's actually a big percentage of the overall portfolio. Let's look at U.S. agencies. So if you look at September 30, it was 30.12%. Now you can see in December 31st, it was 35.7%. And so what happened over that period of time is that the U.S. agencies were issuing debt. And so that would be Fannie Mae and Freddie Mac. And they were issuing debt at fairly wide spreads relative to where they had been in the past. And so what we had done is added some of those securities that are in there. If we look at our purchases that we made back then versus where some of those agencies are trading today, basically the spread, i.e. the amount of interest that you earn over a U.S. Treasury by holding that agency security, is down. So i.e. the yield is lower, i.e. the capital gains or appreciation of those assets actually was very good over that period of time. So that's one example of that.
Thanks.
Okay, also on this item is the investment policy red line. Are we going to
Mhm.
speak, Jeff, are you going to speak to that or?
I think that's Mia. Or I'm not sure.
Okay,
Jeff, are you still on the line?
if you are, we can't hear you.
Looks like you're muted, Jeff. If you're the phone line,
Can
it
you
looks
hear me
like
now?
there you are.
Can you hear me now?
Yes.
Yeah, sorry.
So who's doing the investment policy, Jeff? Jeff?
Mia, do you know if you're doing it? I show you listed on the agenda for item A. It was Jason and yourself for this. Are you scheduled to do the presentation? If so, I think we can go ahead and turn it over to you.
Hi, Sylvia. This is Mia. I'm
Hi.
here, but Jason will review the changes to the investment policy.
So we have a couple of changes to the investment policy, or proposed changes, I should say, to the investment policy. And let me go through those relatively quickly here. There was essentially a change to the California Government Code that went in effect as of 1/1/2021. And so it is SB 998. And so this was a bill that was put forth by State Senator Morlock from Orange County. And so one of the things that's happening, or that changed, is that if you look around the world today, there are countries with negative interest rates. And I think we've all seen those in the paper. That might be Japan, that may be Germany, things like that. And right now, the California Government Code does not allow you to invest in securities that have a negative accrual. And so with the SB 998, with the amendment of that, it now allows you to do that in government securities. And so what we've done is really placed a portion or a piece of it in here, a piece of language that is on, let me get to that page just real quick here. This is on page,
Sylvia, the agenda, for some reason on my computer is not active. So is there something that I should be looking on the package?
You mean as far as a presentation from Jason right now?
Whatever we're covering now.
No, he's not sharing his screen. I believe he's just providing a verbal presentation. Is that correct, Jason?
yes.
Yeah.
There
So the
wasn't any documents for this?
We're still on item A. So I believe anything he's going over is part of that. And the last I show is, Jason, I don't think you have any physical or a document to what you're addressing at this time. Is that correct?
No, the document was part of the package, I believe.
Yeah, there's a red line for the investment policy. There's a 4A1 investment policy red line, and then there's a copy no red line.
Correct.
So
But
we really just need to highlight the changes and move on.
correct. I just meant there's no presentation to what he's speaking to. It's just on the attachments are in the agenda packet. Gostel, I can email it separately if you need me to.
I just need to know where they're at on the package because it's all combined. I guess, do I have to skip all the way down?
Go to page 45 of the document. So 45 of 100 is the investment policy.
I'm there now.
And so the changes are, one is for SB 998. Basically, it would allow us to invest in basically securities that would have no interest accrual. Basically, that would be in an exigent circumstance where we have exhausted all of our other options. And really, that's just the safety of funds, if you think about that. So putting those funds so that they are safe. We don't expect that would happen in this country, but that piece of language is in that policy. In addition to that, they also increase the amount of commercial paper that can be purchased, which moved from 25 to 40% in commercial paper So we're asking also for the policy to be amended to allow for that. And what that does is some of these things sunset in 2026, and we have that outlined in the policy so that when they do sunset, those things will go away unless there's additional legislation. And then also we put some additional language provided for basically some prohibited practices in the investment policy. And so that's where you'll see the negative accrual, but also we took an opportunity to put those in there also. And so those are really the material pieces in the investment policy that we're asking or requesting permission for those changes. So it's not very major. You already purchased commercial paper today, and we're just updating the policy per SB 998 in order to allow for negatively accruing securities.
I have a quick question, Jason.
Sure.
Can you just give me a quick description of what commercial paper is?
Sure. So what commercial paper is commercial paper is a short-term obligation of a corporation or a municipality, some kind of non-government type agency piece. And so typically it's going to mature in 270 days. That's typically the maximum maturity for commercial paper. And the district can only buy high quality commercial paper. So it can only buy those securities that are of the utmost credit quality. And so typically they're thought of as being very safe, liquid investments. And let me give you an example of somebody that might issue commercial paper. Johnson & Johnson, Walmart, some of those types of corporations would issue commercial paper. And so they are really, very safe investments and liquid too at the same time.
And the change that we are making.
So the overall percentage moves from what it is today of around 25% to 40%. And so the state code only allowed for 25% before now, and now that state code allows for 40%. And it only allows you to buy 40% if you're an entity that has $100 million or more of investable assets, which the district does.
Okay, so we're saying that we're going from 25 to 40% of our portfolio, which is what we just went over, the 300 and some million?
Yes.
Well, let's clarify that just a bit. Are we actually going to move our investments to 40%, or 40% is the maximum we can hold?
40% is the maximum that you can hold in the portfolio. We would not be moving our portfolio to that at this point in time. And so, yes, thank you very much, Jim, for asking that question. So yes, we are not requesting permission to move the portfolio to 40%. We're just asking for the governing document to allow us to do that if we saw fit, and it was part of the goals of the district.
This is Jeff Keel here. Sorry, I was having trouble with my laptop for both video and audio, so I came and joined Carrie. So just a point of clarification in case it wasn't already made. All of these changes are focused on getting us into alignment with the California state policy. It doesn't mean we want to do more of investing in commercial paper. We just feel that it's expedient to accept the changes where they're prudent, so we can say we are 100% in alignment with California investment policy.
Okay, thank you.
Yes, sir.
And the other changes were just, not very material, just some small changes there and there, but the meat of it is the commercial paper and also the zero interest accrual securities.
Okay, if there's no other questions, we can move on.
Yeah. Item 4B, the OPEB investment performance. I'm not sure if Ellen.
We have Ellen Clark from PFM.
And
who's going to
Joseph.
give that
Okay.
presentation. Thank you.
Hi there. I just want to make sure that everybody can hear me.
Yes,
We
Yes,
can.
Okay.
and see you now.
Let's see.
Okay, well, I thought I'd just give Jason the floor since he had the floor. So I'm pleased to be with you today, and we're shifting gears. I will share my screen. Is that what you want me to do here? Okay, just a
Yes,
second.
please.
Let me tee that up. Okay, you all should be able to see my screen now.
Yes.
Okay.
Yes.
So shifting gears, I'm Ellen Clark, director with PFM, and PFM has the pleasure of managing your OPEB trust. So this trust is not subject to California government code that Jason was just going over. You do have the ability within this trust to invest in stocks and longer term and lower quality bonds. So I'm going to go through my presentation fairly quickly. Jason has covered a number of the items that I had in my presentation, so it shouldn't take too long, but I do have a couple of different things to talk about here. Starting off with market performance, and we did not have the opportunity to meet as a committee in 2020, since 2020 was quite a year. And as Jason said earlier, the stock market had a very good year. The bond market actually had a very good year. And what I'm showing you on this page is I'm showing you the performance of the markets as measured by different indices for the fourth quarter, for 2020, and then 3, 5, and 10 years. The indices that we use to create the benchmark for this OPEB portfolio are the Russell 3000 index, the MSCI ACWI US here for international stocks, and the Barclays US aggregate for fixed income. So we had an 18% year in the stock market. Now, at the end of March, we didn't think we were going to have an 18% year, but we had an 18% year in the market, and we had a very, very strong fourth quarter. So the last half of the year was extremely strong, with the March downturn being very rapid and happening over the course of about 25 days. The domestic market did much better than the international markets. The international markets were only up about half of what the domestic markets were up, but still bounded back fairly significantly there in the fourth quarter. I want you to also look at the long-term numbers here. I'll show you in a few slides that PFM does not think that a 14% annualized rate of return on US stocks is possible on a going forward basis. We actually do think that something in the 5 to 7% range is possible for both domestic and US stocks on a going forward basis. But we've enjoyed some very excellent returns in the stock market since the great financial crisis, which happened in 2008, 2009. And because of the way the US responded, a little bit different than the way the rest of the world responded to that great financial crisis, is the reason that we see the much better returns in the US market versus outside the US. The fixed income markets in 2020 were supported by a severe decline in rates from the first of the year. Really, it happened very quickly as the Fed stepped in to support the economy in the face of the pandemic. So a 7.5% rate of return. We have low interest rates. As Jason said, we expect to see low interest rates for the remainder of this year, 2022, and PFM even thinks into 2023.
You didn't want me to take the camera off. No.
So we'll shift to the next page, which shows you some numbers for the change in real GDP growth in the US, as well as a projection of unemployment rates. And this is coming out of the Federal Reserve. Jason already reported that we've come into the fourth quarter numbers. We're a positive 4% for GDP growth in the US, which ended up with a negative 3.5% annualized GDP growth for the year. Going forward, we do think that 2021 is going to be a good year. There's more risk in the first half of the year than in the second half of the year as we get the distribution of the vaccine and inoculation of the population. And then we expect the GDP growth to settle into the 2 to 3% range. Really that's where it was before we hit this hiccup with the pandemic in 2020. As Jason said, unemployment has been fairly significant. We came into the pandemic with record low unemployment at 3.5%. It skyrocketed to more than 15%. And we're sitting in the 7% area right now. We are continuing to see fairly significant unemployment claims. And you see here the projection by the Fed that we still will have elevated unemployment through 2021 and into 2022, not coming back down below the 4% level till 2023. So unemployment is one of the measures that we look at to determine what the economic environment will look like going forward. In the fourth quarter, we did see some hesitancy in the market. We saw some more shutdowns of the economy, not only in California, but across the United States as the pandemic took hold in some of the other areas that hadn't seen as many cases as we have here. So consumer confidence took a bit of a dip. Mr. Estrada, you see that retail sales there jumped in the middle of the year in the July timeframe, and then tailed off significantly even as we came into the holiday season. And that is a measure also of the consumer and what the consumer is doing. And the consumer is about 2/3 to 3/4 of US GDP. Small business optimism took a dip, and so did new home sales. So those were just some of the things that we look at. We do expect the latter part of the year to be bolstered fairly significantly. And as Jason said earlier as well, we are seeing a record savings rate. So there is some pent up demand. With the stock market soaring to a 20% return, we also have seen household net worth jump. So you've got a couple of things impacting that. People aren't out spending their money because they're at home. And then you've also seen some wealth creation as a result of the stock market increase. Not only has the Fed been very supportive of the economy, but so has the government. And yes, we have run up our debt significantly. That is something that we do have to think about, but it's probably a long-term problem rather than a short-term problem. And this just goes through one of the most recent pandemic relief packages. And we've got another one that in front of Congress right now. So I think that Jason went through this as well. This is the Treasury yield curve with the dotted line being where the curve was in December 31, 2019, and the solid dark blue line being where the yield curve was as the end of 2020. So your portfolio here is mostly affected by how the stock market did, and the stock market had a pretty significant year last year. We came into the year thinking things were pretty positive. We hit a high on the 19th of February, and then the market plummeted to its low on March 23rd. And then it had a little bit of a gyration, but it basically climbed out and it had an 18.4% return on the S&P 500 and almost a 21% return if you put in small cap stocks. So the PFM team did a lot of work in 2020 for the district, and I'll go through some of the decisions our investment committee made over the course of the year. But I wanted to let you know where the portfolio sits as of 12/31. Here we have the market value of the portfolio at about $32.5 million as of December 31st, 2020. And what you can see at the bottom of this page is you can see how the portfolio is structured from an asset class perspective. The blue line tells you where the actual allocation of the portfolio is. The yellow line is the target policy that's in the investment policy for the portfolio, and the red lines are the differentials. And what you see is that PFM is overweight equities at the expense of fixed income. We do think that stocks will do better than bonds in 2021. And we have that overweight in domestic stocks as well as in international stocks. So let's go through some of the decisions that were made in 2020 on behalf of the district in this portfolio by the Multi-Asset Class Investment Committee at PFM. Again, what I'm showing you here at the top of the page is that market line for the S&P 500. The red dots are where we were making decisions as we were going into the decline and coming out of the decline. And then the green dots were the remainder of the year. We call the red dots some decisions that we made to reduce risk in the portfolio. The biggest thing that we did is on February 28th, March 2nd or 3rd, that first week of March, we had an overweight coming into the year in stocks. We were about 110% of target. And we took that down to 80% of target in one fell swoop that first week of March. We did that because of the information about the pandemic, and half of the proceeds went into fixed income and the other half of the proceeds went into cash. The reason that half of the proceeds went into the cash, you'll see, because we did see the market reach its bottom and we started buying stocks back into the portfolio, and we wanted to have that flexibility as we saw this market falling apart at the 1st of March. So we did take the portfolio to about 90% of target right after the bottom of the market. But we got a little bit hesitant. And then a week later, we took that 5% out as the market continued to go up. So the next thing that we did was look at the fixed income side of the portfolio. We saw a fair amount of disruption in the fixed income side of the portfolio as the market took its dive. There was a flight to quality. So for the first couple of quarters of the year, treasuries and agencies outpaced corporates significantly. And we actually have a fair amount of the portfolio in credit paper, including corporate bonds so we had a lot of dislocation. One of the areas that we had dislocation was in the area of municipal securities. So we added a 6% position in municipal bonds to take advantage of that price dislocation in something that's very, very safe and has a higher probability of paying its dividend or its interest payments than the corporate market. So we thought that that was a very apropos and kind of unusual tactical move that we made. Then you'll see that we did increase equities to 90% at the end of May. We also added a position in convertible bonds, a little bit in high yield bonds, and also in emerging market debt as we tried to structure the fixed income side of the portfolio to pick up some yield. Suffice to say that we removed our overweight to fixed income. We went to a target weight in equity in August. We also took out of the portfolio the municipal position and the convertible bond position as those met our objectives very quickly. So that happened here at the end of August and at the beginning of September. One other thing that we did in the fourth quarter is that we added to our small cap position domestically and internationally. We thought that the domestic and international small and mid cap markets would fare better than the large cap markets, as the large cap markets have gotten a bit overpriced. And that did prove to be true in the fourth quarter and continued to be true as we came into 2021. So that's a lot of movement in the portfolio. We do send an advice to Jeff and Carrie anytime that we make a change to the portfolio, so that you do know that what we're doing in the portfolio and why we're doing what we are doing. Here I'm showing you the performance of the portfolio. So how did all of those moves fare for the portfolio? And so the top line is your performance for the OPEB trust. And over the course of 2020, the portfolio had a return of 16.7%, which was 260 basis points or 2.6% better than the blended benchmark at 14.1%. Over since inception, you are seeing almost a 10.5% rate of return annualized on this portfolio versus the market at 9.8%. As I alluded to earlier, we do not think that those types of returns are possible on a going forward basis. We do see some of those returns coming down into the 6 to 7% range for the next 5 years. So on an annual basis, PFM puts together these capital markets assumptions, and the intermediate term is the next 5 years and long term is for the next 30 or in perpetuity. The other thing that I'd like to note is that we do not see very good returns coming out of the fixed income side of the portfolio as the Fed continues to keep rates low. If anything, as we've seen here in the first month of January, as rates start to go up a little bit, even a little bit, the portfolios are suffering a bit from a rate of return standpoint because there's not enough interest income to buffer the portfolio for any price change. So the Barclays aggregate, just for your information, was down about 7.7% for the first month of 2021. So what's our strategy going forward? We do think that the economy is improving and that we will have a strong recovery. It will probably come later in the year rather than early in the year. And that is domestically as well as international. We are more positive on stocks than we are on fixed income. So hence we are overweight stocks and underweight fixed income, and will continue at least for the foreseeable future to have that positioning in the portfolio. And then within equities, we are more positive on small and mid-cap stocks. We have increased our allocation to international stocks. International stocks are trading at a discount to US stocks, so they're a little bit more attractively priced, although there are some economic concerns outside of the US that we continue to monitor. The Federal Reserve, as I said earlier, we do expect to continue to keep rates low, so that will hamper returns for the fixed income side of the portfolio. So we are looking for ways to structure the fixed income side of the portfolio to gain at least a little bit of yield advantage. So with that, I will conclude my comments and open to any questions that you all may have.
I have a question.
Okay.
Yes.
Oh, can you, I can't see myself, so can you hear me? Okay.
We can hear you.
I can.
Okay, great. This is Director Aguilar. So thank you, by the way, this is really very comprehensive. So I'm just curious about something that was not mentioned, and I know this is not, I didn't see anything in CVWD's policy about it, but when you're making your equity investment decisions in the portfolio, particularly on international products, is there any filter for things like companies who may practice, unfair labor issues, or who have humanitarian issues, rights violations, things like that? Is that something that you look at, or is that something that is not part of your formula?
Director Aguilar, what PFM does with this portfolio is that we actually are a manager of managers, and we go out and we hire managers to manage the domestic equity portfolio, the international equity portfolio, and the fixed income portfolio. And we have several different managers. I am not aware that in particular, any of our international managers are looking at employment practices or business practices, but I can get that information and pass that along to Jeff, and he can get that to you. We do have a product, if you will, or we do have a environmental, social, and governance and ESG portfolio that we do run for some clients. So that, but that would be the portfolio as a whole, not just the international piece of the portfolio. We do take that into consideration. That is something that we do look at, but we do not limit the managers that we look at to the managers that are employing those sorts of screens in selecting stocks.
Thank you. I
Unless
appreciate,
you're part of the ESG platform.
unless you're part of that particular group. I understand that. Yeah, that's very helpful. I appreciate your feedback. Thank you. And if you have anything on it, I realize that's not part of the board's investment strategy, but I would be personally interested in how that works. If you've got anything, thank you.
I'll send that to Jeff.
Thanks.
I don't see any other hands raised for questions. Director Estrada?
No, thank you.
No. Ralph, Robert, Jim?
No, ma'am. Let's move on.
Okay.
Thank you
So-
very much. I know that it was a kind of a rocky year, but your portfolio did very well. And we'll hope to, I can't guarantee over 200 basis points in 2021, but we'll hope to continue to outperform the benchmark.
You did have the disclaimer there on the last page, Ellen.
Yeah.
So I think you're safe. Well, Happy New Year.
Happy New Year to you all. I'll stop sharing here so that you can go on to the next
Okay.
agenda item.
And the
Thank you.
next item is the discussion on the reserve policy review and update, and that's by internal staff, Jeff and Carrie Swain.
Thank you, Sylvia. This is Jeff. So we had primarily left this on the agenda as a placeholder in case the board didn't approve the updated reserve policy changes as presented at the last board meeting. I believe there was one question that we were trying to answer. Darren, are you on the line?
I am. Good afternoon, Jeff.
Did you have a follow-up answer to one of the questions that a board member brought up?
Yeah, no, absolutely. And happy to kind of weigh in. I apologize to everyone for not bringing this up on last week's call. So as Jeff mentioned last week, as we were looking at the reserve policy, obviously the purpose of the reserve policy is both operational and financial. And from the financial perspective, when we look at a reserve policy, we want to make sure that it's sufficient to cover us in unknown situations and able to kind of do a strategic mix of both pay-go and debt capital finance in the future. And so one of the things that Jeff mentioned on last week's call, which was spot on, is that even though when we look at the reserve policy from a financial standpoint, more is always better, we recognize that the reserve policy has to fit within what the district operationally wants to do. And Jeff really highlighted that clearly. The one item that we wanted to go into a little bit more detail about today was when we look at the overall reserve position, particularly as it relates to the upcoming debt issuance at East RAC, we want to make sure that everyone's kind of fully aware of the potential considerations as well as our approach with the rating agencies, because as we've talked about in the past, ratings are probably one of the single most important factors which determine our borrowing cost. And so, and I believe Director Estrada, you were spot on when you asked the question when we were looking through the reserve amounts of, do the rating agencies look at reserves of the district as a whole and individually within the funds? And as Jeff mentioned, yes, they look both district-wide at our reserves as well as the individual funds that are borrowing money. And that's particularly relevant with regards to East RAC, because when you look at the reserve levels within East RAC over the last several years, and then look at the budget for 21, the one consideration that we have is that we're showing those reserves being spent down near zero. And from a ratings perspective, that could be a potential challenge because, again, when they look at the individual fund, the liquidity within that fund, having it go down to zero requires some explanation. And it's a potential concern. And the way that we have addressed that is really what I wanted to highlight today and talk about and answer any questions. So early on, we recognized that as a potential concern. But when we talk to the rating agencies as part of our indicative ratings process, the strategy that we took was that the spend down of those reserves has been strategic. It's not something that was unexpected. It's something that was planned. And when the rating agencies look at our overall liquidity position, they need to take into account the broader district's unrestricted and designated cash reserves, because the district has a long history of utilizing interfund loans and transfers to support funds when it's necessary. And so that's really the way that we tried to mitigate and offset that concern. Whether or not that's successful, we're still waiting. We had a presentation to S&P in the last few weeks. We're hoping to hear back from them in about 2 weeks. And we'll know whether or not that strategy was successful. But in the meantime, what we did want to do is make sure that those considerations and that concern was, shared and recognized.
Okay, yeah, and I think I saw your an email that came through with some of that explanation. So thank you for that. I guess to try to get a sense of when you talk about, kind of telling the story related to how those funds have been drawn down and kind of being planned for, would you say that's been mainly the drawdown from paying back domestic for the Tommy C. Levy? Is that really what drove it down, Jim? The repayment of that? I think that's what we perhaps talked about 3 years ago, that we were gonna try to repay back that loan. And I think perhaps that would have been the biggest drawdown. I don't recall there being a lot of CIP attributed to East RAC, perhaps maybe 5 million that I can think of. I know those pump stations were probably big, but thinking in the future, I don't know that there is much CIP remaining out there. I know that there's probably some of those connections that we still want to make, but I don't know that I'd be in favor of that if this is the situation that we're finding ourselves in, where we don't have any more funds to pay for capital projects. And so if it's going to be a situation where the only way we get to build those projects is by raising the rate, then I think we're going to run into some issues.
No, I think that's an accurate reflection of where we are. I think we did spend a lot of state water project reserves in paying back the Levy facility, you may recall. That was about a $45–50 million cost. And whether or not, based on litigation that's ongoing, whether that creates an even larger liability for us, in that we might have to pay that back to the state water project fund. Well, we'll have to wait and see and what type of timeline we have for that. But I think it's inevitable that the rate in the East Valley is going to go up. You could say it's because of the Oasis project. You could say it's because of connections for non-potable. And I agree, there aren't really that many. But we were looking at the East Valley RAC to be the mechanism that could pay the debt service for the Oasis project, because we can't use the canal fund, because the canal fund can't pay to extend itself to future customers.
Sure, but we're moving some of that unrestricted.
Discretionary, right? It's the Prop 1, discretionary property tax that we've got.
So that's, in theory, that shouldn't be an issue, because that should have been, that should be canceling out, I think, in theory.
Director Estrada, this is Jeff Keel.
Yeah.
Can I just chime in real quick?
Sure.
So there's a few factors moving here with the East RAC. We don't really have that on our agenda. We do have the upcoming study session on RAC and Sigma. It'll be coming up very soon, I believe on the 16th. But the CIP isn't the major driver of the spend down. It's really operating costs, and chief among those is water costs. So that
ramp ups.
I'm sorry, I didn't.
QSA ramp up.
Yes, sir. It's the ramp up. So, and Mr. Barrett's statement regarding the State Water Project is correct. And so we, to be protective of the district regarding these lawsuit issues and to provide further transparency on that. So we've reinstituted the State Water Project. So, the revenues and expenses and all that has been moved out in a separate fund. Now, regarding your statement about, or question about the repayment of the Thomas E. Levy loans, as you recall, we're kind of in the tail end of that, and there is the last slug of principal due. We had the option of re-amortizing that payment schedule. We could have spread it out over a number of years. We had a discussion with the board, you may recall, in last year's budget, that would end up having an impact on ultimately on domestic rates coming into this new cost of service study. And the other part of our story with the ratings agencies is the board's desire to go ahead and make a clean slate and extinguish the old and remaining debt before we go into new debt regarding the Oasis project. It's a very complicated credit to be telling the story on.
What are you classifying as old debt? The Tommy C. Levy?
Yes, sir. Yes, sir. I'm sorry for
and
that.
What's that number that you're trying to spread across? What's that? Like 2 million, 5 million? What is it?
It's not a huge amount. I believe it's, is it 7 million? Yes. So it is helpful. It's already been helpful with Standard & Poor's, as we've been saying. Look, yes, it's made the reserve go down, but we're trying to make it more straightforward. The picture going forward, there's going to be one debt to repay. That's the Oasis bond, and it's going to have the discretionary property tax revenues brought over in an amount appropriate to what needs to be there in order to pay for the debt service.
And what you're saying is that there's also the idea that domestic is anticipating that 7 million?
Yeah.
So
yeah, go ahead. Carrie has a correction.
Sorry, the total amount due is still 13. So the plan was to pay it in 2 years. So it's $7 million, almost 7 million each year for the next 2 years to pay it down. So that as of right now, we still owe 13 million interfund loans.
And then we'll be done with that. And the other good news item is that the QSA agreement costs are going away at the end of 26. So that's a couple of good news items in presenting the story on the East. That's about the end of the good news items, because it's a tough fund to present. Yes.
When is the study session?
The 16th. February 16th. And if you don't mind, we've got our last item, we've got one more in between, but is to just discuss where we're going with the Oasis bond. So maybe we could pause on this discussion for a moment, or we can go right to it and then pick up item 4 as the last item to reorder.
No, I think that I think we talked enough about the issue that you wanted to identify from what we heard at the last board meeting. And so if I need to get more into the weeds, I'll make sure that I contact you.
Okay, well, this is the weeds committee for you. So, we want to give you opportunity to do deeper dives here where it may be a little less comfortable in a full board meeting.
Okay. But I'm ready to move on.
Okay, thank you, sir. So next we have on the, is there any other questions on this? Okay.
Are we, Jeff, are we moving on from discussing the debt issue, the ratings?
Yeah, yes, we're moving on from the reserve policy to the miscellaneous fee study.
Okay, so, sorry.
Go ahead, sir.
Go ahead.
Okay, I just had a quick question. I don't know if this would be Jeff or maybe the speaker who was doing the presentation about the rating agencies. So there are 3 rating agencies, and do they all have to issue, you mentioned the presentation that you either had or were coming up. Do all 3 rating agencies have to issue the same rating, or can they be different and is therefore a blended rate, the one that ultimately sticks with the debt and impacts what the cost of that debt is going to be? How does that work?
Well, Darren can provide you details, but there are 3 major rating agencies that are typically used. The typical way is to have 1 or 2 of those agencies. With the last year's WIFIA loan, we did 2 because it was required by federal regulations. And so we ended up having the Standard & Poor's and Fitch do ratings. There's no such requirement related to the OASIS bond. So it's all a matter of what is going to be most beneficial to the district in marketing these bonds. If we receive a favorable enough rating from Standard & Poor's, we're probably going to save the money on doing a second one and not do a second one and just proceed with Standard & Poor's and have them finalize their full ratings presentation and again, not seek another rating. I think there's a pretty strong likelihood that whatever we see from the indicative rating is going to be, if not right where the final one would be, very close. Darren, did you have anything else to add?
The only thing I'd add, Director Aguilar, is that when we receive multiple ratings, they are separate ratings. There's no blending. And so to the extent that you have 2 ratings and they're very similar, like we had on stormwater at AAA, AA plus, you know, investors look at it and say, okay, they're pretty close. To kind of to get at what your question is, if there's 2 ratings and they're vastly different, well, then that causes questions among investors. And so, as Jeff mentioned, the reason we're using 1 is because they're not cheap. You're talking $30,000 to $50,000 for a rating. And if we can save the cost of one of those, then we should do that.
Sure. And their methodologies are different. So it's not like you're comparing 3 identical services provided by 3 different companies. Yes, they have ratings that have somewhat consistency with each other, but they do have different methodologies.
I get that. Thank you. It was a great explanation. Thank you.
Thank you, sir. So let's jump quickly. We're going to have a quick verbal update from Carrie Swain on our miscellaneous fee study. And I know we're kind of going a little farther time-wise than we had intended.
Hi, good afternoon. So just to provide a quick update. So the miscellaneous fee study, we started this effort in 2018. We started with a cost allocation plan. And now we have moved on to doing a cost of service study for our user fees. And so the last time a formal cost of service for user fees was done was back in 2012. So that was almost 8 years ago. So it was time for us to go ahead and review our cost of service related to these user fees. So the ending result is, the result of the test is we're currently covering about on average 73 to 77% of our cost. So the proposal that's going to be coming up is, again, it depends on the board's direction. Our plan is to propose some of it at 100% cost recovery or another percentage that the board feels comfortable with. The plan is to have that go to board approval on February 23rd, the next board meeting. And we did submit this to our Builders Association around the community, both the Builders Industry Association and also the Desert Valley Builders Association back in October. And we have received confirmation from Desert Valley of their review and approval and support of the proposed fees as well. So that's good news for us that they're supporting our proposed fees. And so that's a short update on the miscellaneous fee study. So want to move on to the OASIS?
Yes, I
If you have any
apologize.
questions.
We didn't provide you the full report this time due to considerations about time. But yeah, this has been something that's been in the works for a while. We just wanted to give you a quick update since we hadn't updated the Finance Committee for some time on that item.
You're doing the miscellaneous study across all funds, and I guess the question is, can you give me a quick example of what you consider miscellaneous fees and whether or not those are also impact fees?
So these are not the fees that we're looking into are, for example, landscape plan check fees, development review letters, so engineering services, some meter services as well, and environmental lab fees. So engineering, I think, is embarking on a full impact fee. And that's another cost of service that's going to be done in the future.
Yes, engineering is working on a developer services RFP. They put it out once and they didn't get any responses there. We received feedback just this morning on why. And so I think the director of engineering is going to be looking at options for continuing to pursue the developer fee study, not through an RFP, through some other means. But that's not for me to speak to. That's really Carrie Oliphant's bailiwick.
What's your schedule in terms of when you hope to bring something for adoption?
For this miscellaneous fee, it's going to be in the next board meeting, but the implementation is not planned for until July.
So you're thinking of bringing the miscellaneous, whatever those fees are going to be, you plan to bring that in at the next board meeting?
Yes, on the 23rd, that was the plan. But the fees are supposed to be implemented July 1st.
No, yeah, not the next board meeting, the
Yes,
meeting of February 23rd.
Which is, yes, I'm sorry, yes.
Mhm.
Have we had a study session on these fees?
Not per se. We haven't had one in quite some time. We had one back in either 2018 or 2019 when we got the draft from the consultant, which the board was not particularly pleased with. And then we sent the consultant back and they've come back with revised recommendations. But no, we have not had a study session on them.
But you're pretty comfortable that, so are you planning to have a full presentation at the board meeting and then hoping that you're going to get an approval? And you feel pretty comfortable that?
Well, I am hoping to get an approval. I'm not very confident that the board will agree. Because as you heard Carrie say, we've only been recovering 75, 77% of our cost. So when we don't recover 100% of our cost, it bleeds over into other activities. We've got to find that cash somewhere else, or we stop doing the service. And these are services that we provide to the outside world. And, you know, we'll just have to have that discussion. I don't know that we've dropped any of the charges to the best of my knowledge. So it's going to be difficult.
I guess my request would be that why don't we get together before that meeting with myself and Director Aguilar to at least have a broader understanding of where we're at and how we got there. Perhaps if you feel that, you know, that's worthwhile, and I don't know how prepared we'll be if we just.
I agree. So why don't I ask Jeff and Carrie to send you what we've got, whether there's a quick summary, an executive summary that's part of the report we got, or whether there's just a bunch of charges, what they were and what they will be, or could be, or what staff is recommending they be. At least you'll have a better sense of what it is we're talking about. I guess I apologize that there wasn't anything provided with this item on the financial committee, because you're right, we haven't given you anything.
Yeah, I mean, I don't know if you put this out. It sounds like you put it out to an RFP. So is there an actual study that was put together that looked at the cost of services being provided and all that?
Yes, sir.
There was a presentation back. I've got a copy of it. I can't remember whether it was May of 2018 or May of 2019, but there was a report that we got, a presentation to the board. I think there were at least 2 presentations to the board, if I remember correctly. I don't, Jeff, you'd have to.
Yeah, well, it's been a while, but yeah, why don't we do that so that Director Aguilar and myself are just kind of, maybe we just need to remember or something.
We will do that, sir. Thank you for the suggestion.
Yeah, this is John. I think that's a good idea. I would support you, Director Estrada, on that. Could you include in the information the letters from the DVBA and the BIA folks in that information that comes to us, please?
Yes.
We will do. BIA did not respond, which is typical for them.
Okay.
John, you may recall the history there, that we used to have a builder industry association chapter here.
Yeah, something
but they
like that.
dissolved themselves and formed the DVBA. There has been on and off a representative for BIA out here in the Valley. I think the latest one was Erica Harnick, who's one of Jan's daughters. And she wound up dropping that and is now working for Chad Mays, or was prior to the election. So I don't know that they've filled that position here locally. They're really not the folks we go to, although by legislation, we do provide them a copy of our developer fees, our impact fees, so that they can take a look at it. And then we also send them, Carrie sends them reconciliation of where the money was spent on an annual basis, which again, we're required to do.
Okay.
So we have them in the discussion. I just don't think this rises to their level, because it's not, as we were trying to explain to Costello, these aren't the developer fees like the water systems backup facility charge or the collection and treatment capacity charges that we have on the sanitation side.
Thank you. Yeah, no, I was just responding to a comment that somebody made that said that they had received a letter of support.
Yes.
Harry did.
Yeah, so that's what I'd like to see.
Okay.
And Jim, I show the draft report of the cost of services user fee study for the miscellaneous fee was presented to the Finance Committee on June 6th of 2019.
Okay.
So it's been a while.
Okay, last item.
Last item, Oasis bond.
Yes, we have included the calendar of events, and I'm going to let Darren speak to this. Once we had the indication that we had an impending approval for the project, and that we would be selecting a contractor very soon, we jumped on it to get the financing piece going. And so Darren Hodge and PFM and our bond counsel, Doug Brown with Stradling, their team has been working with us quite diligently to get this underway so we could have the financing in place. The two-part strategy we're taking is that over the months remaining in this fiscal year, engineering expects they'll need to spend approximately $8 million. Could be more, could be less. I think the probability of being less is probably the stronger possibility, but we're using Bank of the West our line of credit as bridge financing for that. And then this bond, we're looking at having that completed and issued and funded by the first week of May. And we would have the opportunity to repay the line of credit then. So with that, I'm going to turn it over to Darren and he can fill us in on some more details.
Sure. And as Jeff mentioned, there's a couple large steps that we undertake within each transaction. The first is we get
Darren,
on board. The second is we develop a plan of finance.
Can hear.
Hey, Darren, you're freezing up. You're frozen and your audio is scrambled coming in. Oh, we lost him. Technology, I love it.
End of item.
I know.
Okay, I apologize.
There he is. Okay.
Is that better now?
No, we lost you again. Do you want to try at least calling in and then maybe your audio, if you have a phone line you can use?
It doesn't help if we cut our video, right? It's all on his end.
Can you hear me now? Is that better?
Not really.
Not really.
But we did hear you. Hence our response.
I have heard that if you cut video, it helps. I don't know if it's true or not, but I have heard that.
I think if it's all internal, but it's different, different connections coming in. And I mean, our board meeting last time was pretty successful. Our ledge was pretty successful.
Yeah.
And we had about the same number of people on there.
Okay.
Yeah, we've had some problems with the Gulf and Water Task Force. Craig Kessler is having problems on a regular basis now, but I think it's his
Okay.
broadcast. That's limited.
I think Darren just joined via phone. Let's see.
Okay, I'll shut up now.
He's still, you're muted, Darren, on that phone line. If that's you calling from the 480 number, there you go.
Yeah, can you hear me now?
Yes.
Yes.
I apologize for that. So I'm assuming I should probably start over my discussion of schedule. Is that correct?
Yes.
Okay. No, my apologies, everyone. So as Jeff mentioned, there's several key steps that we will need to take within the financing. And the first one we'll need to undertake is going to be apologies. So the first step we're going to need to take is going to be to get the financing team on board. And from there, we will get the plan of finance implemented. And so what that entails is coming up with a security structure, developing the structure of the bonds, which will then go and ultimately get rated. And once we have that in place, then what we'll do is we will come to the board for approval, and then ultimately we will price and close the bonds, as Jeff mentioned, in late May. I'll pause here. Can everyone still hear me clearly?
Yes.
Okay, perfect. And so the steps that we've taken to date, as Jeff mentioned, we've been pretty busy over the last month and a half. And we 2 weeks ago received proposals for underwriters that we sent out prior to the Christmas holiday. And the RFP for underwriters went out to 13 different firms that are active in the California water space. From those 13 firms that received the RFP, we received 6 responses. We then, along with district staff, reviewed the responses and ultimately selected the winning underwriter based off experience, proposed plan of finance, marketing capabilities, as well as fee. And at the end of the day, selected Citigroup to be the underwriter for the 2021 bonds. So in terms of the next steps from here, now that we've got the underwriter on board, we are going to be working with bond counsel, district staff, as well as the underwriters in finalizing our security structure, which is essentially the source of revenues from which we're going to repay bonds. And that will take about the next month and a half to 2 months to get that nailed down. And then from there, we're anticipating coming before the board in late April with approval, and then hopefully pricing and closing the bonds in May. I will say that this schedule, as pretty much all financing schedules, is kind of subject to change. A lot of things can happen. So to the extent that things move around, we'll obviously keep you informed and let you know. But if that does happen, it's pretty normal. With that, I'll pause and see if there's any questions.
So, Darren, thanks. I appreciate the fact that we're kind of on a fast track to get bonds at least developed, if not sold, in May. How much time do we have before we actually start needing financing to pay for the construction contract that's already underway? I mean, do we have some type of bridging document in place or financing to cover what may be coming in the form of contractor invoices?
Jim, if I may,
Yeah.
that's where the $8 million figure came into play. Carrie Oliphant and her staff provided an engineering schedule in connection with the selected contractor.
Right.
Your estimate was 8 with a high of 10, and that's why we started the wheels in motion for doing a draw on Bank of the West funds to that extent.
Okay, I'm just asking that because I think it's important for the committee members to understand that, we have a contract underway. We don't quite have the ultimate financing mechanism in place.
Yes.
So we have to have a bridging scheme there.
Yes. Well, and without money in the fund available, liquid, yes, this is the way we need to go. Are there any other questions?
I have no question.
Okay.
I guess what I'll say is, Jim and Jeff is, and I'm gonna do the same. Either I'm gonna try to reach out to you, or you guys try to give us information, try to reach out to me. But I'd really like to have a real grasp as to how these schemes and bridge documents and all these things are going to pencil out. I'm concerned about the financing for this project, and I just, I don't want to go into it kind of being unsure or so I guess maybe I gotta make time or something to get with both of you.
We can do that. We could actually do that in conjunction with the miscellaneous fee special meeting that we'll probably be having. I would think.
When do you also plan on bringing something to the board for this Oasis stuff? Well, at least to the 3 members.
We will.
What do we need to approve?
Darren, can you help me with that date? I see. March.
Yes. So in late April, the revised schedules in late April will be coming to the board with some approvals, and the documents that we're going to be needing approval on, Director, would be a bond resolution, which is essentially a document that outlines the parameters by which the board kind of directs us to sell bonds, and as well as the authorizing statutes. The second document that we'll be bringing to you for approval is called the preliminary official statement. That's essentially the marketing document that we use to solicit interest from investors. So it's a public document that's out in the market that people can review, understand the credit, and make an investment decision, as well as legal documents which outline the source of security or repayment for the bonds. Those are the primary documents that would go to you for review and approval.
Darren, I think that's great. At least speaks to the board, the bond part of it. But I think what Director Estrada is asking for is kind of an overview of the entire financing picture, not just what steps we need to take to get the board to approve the sale of bonds, if I understand his question correctly.
Yeah, Jim, and I guess, forgive me for my ignorance here, but I guess I'm realizing that I didn't quite, or I don't quite understand how the money actually gets created. And in my mind, and again, these things kind of being new to me, I was under the I didn't know that there was going to be some sort of bond component to all of this.
Well, I think, and you're not wrong. I think initially we were expecting to use the Bank of the West line of credit for the first couple of years. But as we've discussed with the board, we don't have the rate structure in place that will show 7 years or 5 years of debt service coverage, because we haven't approved rates that far out. And the board's basically never really taken the position of looking at rates more than a single year at a time. So that makes it very difficult for us to go forward with the plan that we initially had put forward, which was to try and use the Bank of the West and then take a little bit longer to get the sale of bonds worked out. Right now, the sale of bonds is the only way we've got to progress, rather on a longer term than what we might be able to get through a bridging document or commercial paper.
Okay, and so
it has changed.
Okay, that's what and for some reason to me right now it's just like brand new, I don't know how I missed it or what, but I was still under the assumption that we were going with Bank of the West, and that's why.
Yeah, unfortunately, we don't have the structure in place to do that right now.
Vice President Estrada, I don't recall, you may have missed the meeting we did in December. And
that's
maybe
probably, yeah, there was that meeting I missed where I went to Cadiz.
Yes, sir. So Sylvia, if you could help me with the date, what we will certainly prepare a presentation for you and Director Aguilar, along with when you do the miscellaneous fee study presentation. But in the meantime, you may look at the materials presented at that December meeting. And I'm pausing to give Sylvia time to look it up there.
Yeah, no, I haven't missed the meeting other than the meeting I missed when I went to Cadiz. But I believe it was probably the end of November.
Yeah, so there's an Oasis bond update item that I presented to the board there.
Was it a board meeting or a finance meeting? Sorry, because I have to search by different bodies.
It was a board meeting.
Okay.
And it was actually, I suggested it for this very reason that you're speaking to, that it's been a while since we talked about financing, and I didn't want there to be any surprises or hesitations from the board when we
November 3rd, I think.
were getting down the road on
December 10th.
oh, December 10th. And it is item
It's under, action item
6B.
6B, yeah.
Yeah, that was a special meeting of the
That
board
was
on
a
a
special
Thursday.
meeting. Yeah.
Yes.
Oh, then I was probably there. I'm just not.
I'll look at the minutes. I was
Yeah.
trying to pull minutes.
Yeah.
I should.
So I think that'll help remind you or lift the veil a little bit.
Okay, no, and that's fair enough. I just, in my mind, I was still kind of operating from my memory where we kind of talked about the Bank of the West and how we were going to start off with one drawdown, and then I
Yes.
think it was going to buy us like a number of years until we did the other drawdown, and we were playing around with the different percentages. And I think, you know, so that's kind of where I was coming from, but it sounds like we've changed course now. So
Well, Mr. Barrett very fairly presented the facts of why we had to shift gears and change direction.
okay.
So with that, if there are no further questions, I believe that concludes our agenda. I do just want to mention quite briefly that we recently talked about going ahead and setting a calendar for a year's worth of these meetings. So I'm working with Sylvia now to identify dates that will work for staff here and then our consultants before she will work with the directors Aguilar and Estrada to see what works with your calendars. But we're going to try to do it around the first week every 3 months. So we're talking about like the first or second week of May, August, November, February.
Okay.
Okay.
All right.
That should work.
Thank you, everyone.
Okay.
Thanks, everybody.
Thank you.
Thank
Bye-bye.
you.
Thank you.
Bye now.
Bye-bye.
Bye now.